Happy Wednesday. It is the end of August already, and we are piling up to be a busy year so far. I thought the best way to kind of talk a little bit more about what's going to happen in the upcoming season and just what we're seeing really in the market is FHA buyers. And it's kind of cool because FHA buyers haven't really been able to win in the market for a while now. They keep getting pushed out by getting outbid, and they're getting pushed out by conventional. And there's a couple of reasons why a seller might consider a conventional loan over FHA. So we're going to discuss that. And then we're going to talk about recasting a loan versus refinancing a loan. So hope you got your coffee. It's on to iced coffee for me this morning on Lattes with a shot of mortgage. So let's talk about what is recasting a loan. So something that a lot of clients are finding is they have a ton of equity in their house. We know that. So when they go to purchase, a lot of times right now, the clients that I'm seeing are able to qualify for both mortgages at the same time, which makes it nice for them because they can submit an offer, not being contingent on their current home selling. But then they also have an opportunity after they've moved into the new home to go back to the old house and clean it, stage it, prep it, paint it, do all the little things that really make a difference with this current market that we're in for selling. So obviously, their down payment going into their new house is going to be typically as little as possible. So if they're going into a new home and they're coming in with 5% down, they've got private mortgage insurance, they have a higher mortgage, and they're quite typically upsizing their home. So in a recast, what happens is after they've sold their current home, and this can be any way that they've gotten money, whether it's they get money from a relative who's passed, they get money from a random lottery winning, whatever the case is, that they have a large chunk of cash, which typically there's some kind of minimum between 10 and 30,000 needed. They can go to the loan servicer with this chunk of cash and say, please apply this to my principal balance. The loan servicer is going to charge them a processing fee anywhere between $250 to typically $500. And again, the client always needs to check the fine print because each loan servicer might change what they charge. And then the loan servicer will reduce the full principal balance and then re-amortize it. So in a traditional refinance, you're changing your terms, you're changing the end date of when your mortgage is going to end, and you're changing your interest rate. In a recast, all you're doing is re-amortizing the new balance over the original term and interest rate and end date. So it's nice because you're not refinancing, you're not going into those costs. You've got this large wad of cash that can now help significantly reduce what your monthly minimum payments look like. And it can happen after the other house is sold. So it's a really great opportunity for clients to be able to be comfortable with buying today at this payment, knowing that they plan to sell for this, and now that new payment is going to be this. So it really helps to have those conversations with the clients early on. And it's something that we're finding a lot of clients are really liking. So that way they can just be more comfortable with what their payment will look like in a couple of months. So recasting versus refinancing. Refinancing is never a bad idea. It just depends on what's happening with that person and that client and their needs. They might need to do some debt reconsolidation. They might be looking to take cash out of their current house and use it as a larger down payment, and they don't intend to sell that house. They need to get rid of mortgage insurance or convert from an FHA to a conventional loan. There's a lot of different reasons that somebody will choose a refinance, but a recast is just a nice, clean, simple way to reduce the monthly payment. So let's move on to FHA, because as I'm seeing, I get these reports every single day from Black Knight, which is a company that overlooks how many loan applications are happening, what's happening with loans, how many are being triggered versus being closed, how many locks are being locked, but also what type of loans are being closed. And the big uptake that I'm seeing right now, which makes sense, is FHA. Because for the last 2 years, FHA buyers were having a heck of a time qualifying to outbid conventional buyers. So now that we're starting to see FHA come back to the game plan, and we're starting to see down payment assistance coming back, These are things that we need to resharpen your axe on, because either as the buyer's agent or the selling agent, there's a few things you need to know about FHA. And then next week, we'll have a conversation about Washington State Housing's down payment assistance program. So a couple questions that people ask is, why does the seller care about the loan program being used to purchase the home? Well, there's 4 things that a seller really looks at. Likelihood to close, because you have to imagine your seller or the seller of this home is most likely making mortgage payments until that house closes. So they might have 2 mortgages at the same time, or they might need the funds from this own house to close on another house, or they need the cash to move across country. There could be so many reasons that somebody is selling. And the longer that house sits on the market, obviously, the less value it's going to have. So if a home has been put in stone to be sold to somebody else and it's taken off of the market technically for 30, 40 days, and that seller doesn't go or that buyer doesn't go through, your seller's stuck with that property. And now it's technically been on the market for over 30 days. So it's harder and harder and harder to sell it. So big thing is going to be likelihood to close. FHA buyers sign a legal disclosure that says FHA is an inferior loan product compared to conventional financing. We already know FHA isn't as good as conventional. If the client can qualify to go conventional, they're in a better financial position to go conventional. FHA financing was specifically created to help less likely to qualify consumers to be able to purchase a home. It's meant to help serve someone with credit hurdles or less black and white income or exceptions that we're asking for on the underwriting side, or even higher debt to income ratios. So as the risk goes up for a seller that maybe this person isn't going to be likely to close on this home, it's going to make the offer less attractive than conventional financing. And I can tell you from personal experience, conventional does not always mean that your client is easy and that this file is going to close. There's many times that I get into a position with a client where they can come in with 20% down, but they have credit hurdles, they have other issues that are on the file, but because they have 20% down, we can go conventional. So you do have to find out why a client is choosing to go FHA over conventional. And right now with house prices, part of that could just be the down payment. If this is a first time purchase for somebody, that means that they haven't owned property or a house within the last 3 years, they can do conventional as 3% down, or they can do FHA as 3.5% down. If they have already owned a property in the last 3 years, or they're buying another home, they have to come in with a minimum of 5% down on a conventional loan. So if for some reason they don't have that, it might make sense for them to go FHA. So it's important to find out, why is this offer being FHA? Or if it's your buyer, why is my buyer being suggested to go FHA? So the second thing that kind of can cause somebody to want to take a conventional loan over FHA is the appraisals. So appraisers are going to look a lot more closely at items that conventional financing does. And this goes for all the what we call Govy loans, which are loans under USDA, VA, and FHA. They're all sold under Ginnie Mae, and they all use the exact same appraisal report. What they're looking at is safety issues such as peeling paint, missing appliances, wood to dirt contact. They're going to care heavily about the life of the roof. It could be fence falling over and rotting, could have electrical lines crossing over the roof. And these are things that the appraiser might determine either needs to be repaired before the deal can close, or needs to have another inspection done by a professional to confirm whether that's going to be an issue. And those are typically items conventional doesn't really consider. Now, this makes the sellers, of course, always more wary, because they might have to do some additional repairs prior to closing on that house. And again, it goes right back to point 1, what's the likelihood that this is going to close? So a couple of the other things that FHA looks at and considers is if the lot is graded so that moisture flows away from the house. Again, good condition of the property, all appliances and utilities are working. And then with that roof, it needs to have a minimum of 2 years life left in the roof. The appraisal on the FHA transaction follows the house. So that's number 3. On FHA appraisals, if an FHA buyer comes to buy this property, that appraisal is tied to that house for 6 months. This is the only loan program that does this. So that means that if for some reason this buyer falls out of contract and another FHA person goes into contract to purchase this home, they have to use that same appraisal. They can't request a new one. That appraisal is stuck with the house for 6 months. And there could be issues with that appraisal. There could be problems, things that weren't resolved. Maybe there's disputes between the listing agent and the appraiser. And a lot of times asking for a second appraisal done on an FHA is pretty damn close to impossible. On a conventional home, if there's issues, the conventional appraiser will consider what is being submitted. And if they're difficult or they're not willing to move, or maybe they just don't know that area at all, and we have a good reason to ask for a second appraisal, conventional can order a second appraisal because that appraisal is just for that one-time transaction. It's not tied to the house. On a VA loan, something that gets confused a lot, the appraisal does not stick to the house. The appraisal sticks to the veteran buying that specific property. So if a VA buyer is buying a house and he or she has an appraisal done, that appraisal is stuck with that specific person on that specific house. That does not mean that another veteran coming in can't get another appraisal. They will, because the appraisal isn't stuck with the house like FHA. So that's another concern that a seller is going to have. And then finally, the 4th one, which actually really isn't that big of a deal, but it just sounds like it is everybody knows about the FHA mandatory escape clause. So this is the disclosure that gives FHA homebuyers extra protection to cancel the transaction and receive a refund of any upfront earnest deposit if the value of the home is below the approved and agreed upon sales price. Where this gets confused is a lot of people do think that this disclosure is a caveat for FHA buyers to get out of this transaction under any circumstances. And it's not. It's just saying that if the appraisal comes in under asking price and the buyers don't want to move up and pay extra and the sellers don't want to come down, the buyers want to walk away from the house, the sellers have the ability, or the buyers have the ability to walk away and receive their entire earnest deposit back. Now, this trumps the purchase and sales agreement. So if a client is buying an FHA purchase and they submit a purchase and sales agreement where they have waived the contingency right to low appraisal, this disclosure overrides that. But again, it's just on that value. And that's going to be the same with really any loan. Most people are going to walk away if there can't be some resolution on a low appraisal. So it sounds scarier than it is, but that's just because our mindset is that this is a blanket disclosure. So when you're the listing agent, obviously you need to consider these points for your clients when you're accepting offers. And then you need to know how to work around those. You need to do a good walk around the property and ensure that the home isn't going to have appraisal issues. You know, some of the big ones that I always see are just like all loan programs, missing the CO2 monitor, missing the smoke detectors. That's going to be all loans. With FHA, it's bigger and peeling paint. Missing railings aren't anything more than one stair, or safety issues like the entire patio is missing off of the back door. There's going to be safety issues that definitely are not going to be ones that can be ignored with FHA. There's a few big misconceptions about FHA, and these are really good to go over too, because again, you might have a buyer that's looking at FHA, and FHA is not a bad product. It's just you need to know about the differences between the loans. So an FHA appraiser values the home lower. That's a misconception. That's totally not true. FHA appraisals are like all the other ones when it comes to value. They're going to use comparable neighborhood requirements to prove the value of the home. Appraisers are not bad people. They want the house to close, but their job under FHA is to ensure that what the bank is securing, and technically what Ginnie Mae is going to own under FHA, that we're not buying a bad house that's going to fall apart. That's just the bottom line. The second biggest misconception is that FHA mortgage insurance goes away. It does, and it most likely will not. So FHA mortgage insurance has multiple requirements and different levels that they charge. So first thing to know is that if you're just putting down less than 10% at the time of the purchase, the monthly mortgage insurance never, ever, 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 never goes away on the loan. It will reduce because your amount of mortgage insurance is charged annually and then paid in monthly installments. So each year, as your principal balance reduces on the mortgage, that FHA mortgage insurance is going to come down. But if you're putting down less than 10%, it is never, ever, 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 never, never, never going to go away. If you put down 10%, you pay FHA mortgage insurance for 11 years, and then the mortgage insurance can be removed, but you need to put down 10% at the time that you purchase the home. So that's important to know. If you're putting down between 5 and 9, 3.5 to 5%, the monthly premium being charged is a little bit higher than if you're putting down 10%. So important to know on that too. And then on FHA mortgage insurance, there's a portion of it that's actually charged up front. So this is why FHA is not a superior loan product compared to conventional, is because of the cost. So FHA mortgage insurance premium is charged the same amount no matter the risk layers of the loan versus conventional financing. Their mortgage insurance is based on risk layers, and there's multiple companies that supply the mortgage insurance, so they're competitive with each other. If you have poor credit, if you're coming in with a low down payment, a high debt to income ratio, your mortgage insurance with conventional is going to be expensive. If you're a great financial person, your debt to income is decent, your credit score is good, you're coming in with 5% down, your mortgage insurance premium is going to be a lot better. So they have that, and FHA doesn't. It doesn't matter if you have a 590 credit score or you have an 800 credit score on FHA, your down payment dictates how much your mortgage insurance premium is going to cost. Then you also have the upfront mortgage insurance. So when you purchase a home, FHA charges you 1.75% of the loan as an upfront mortgage insurance premium. Because FHA buyers tend to have a higher track record of defaulting on loans, FHA charges more for their mortgage insurance, and they put it in a big bucket to protect themselves. So what they do is to keep down the monthly cost more, they split that. So they charge you 1.75% of the loan. That's put on the top of the loan, and it's typically financed inside the mortgage. And then you get your monthly mortgage insurance premium. So for example, let's say that you have a conventional buyer and an FHA buyer, both are buying a $400,000 house. And let's just say both of them put down 5%. So if they put down 5%, your conventional buyer, assuming they have good credit, we're just plain numbers. So of course, this is not a true quote at all, but let's just say that they have good credit, lower debt to income, they're coming in with 5%. Their monthly mortgage insurance costs could cost about $126 a month in that $400,000 house, and eventually it goes away. The FHA buyer, exact same scenario, purchasing that house up front, they're going to finance an additional $6,650, so that's going to be inside the mortgage, and then their mortgage insurance premium would be about $257 a month. So not only are they financing almost $7,000 more, but their monthly cost is going up a lot more. So that's a pretty big difference when you're looking at somebody that's qualifying to purchase their first home. And that's why they actually have to sign that disclosure, showing them comparisons of conventional versus FHA. And they just might not qualify for conventional. So they need to go FHA. Or they might be using down payment assistance, and maybe that program is cheaper or only offered through FHA. So that might have to be a route that they go. But it is important that you know why the lender suggests one route over the other for your client. Couple nice things about FHA that I really appreciate. Again, they allow higher debt to income ratio when somebody's purchasing their first home. It's definitely hard to go into that purchase with the down payment, the closing cost, and not have too many debts. My very first house I purchased was FHA, and I was super appreciative of having that opportunity because the monthly mortgage insurance pushed my debt to income a little bit higher, but it still qualified me to purchase. Purchases aren't conventional, they are stricter. They're harder on credit scores, they're harder on debt to income ratio, they're harder on income. So those things allow FHA to be a more flexible model for our clients. So that's kind of it for me for today. I always love to keep these chats a little short so that it can just be enough for you to drink a cup of coffee and digest a little bit more of mortgage shots. So again, we talked about recasting versus refinancing, how that works, and sharpening your axe on FHA. If you're going to be listing a property, reach out to me and we can talk about the listing. And if that house can go FHA, we can talk about the rules around investment properties that are being listed with the FHA and how long they need to have been occupied prior, instead of a flip. We can talk about if you have concerns, if you're walking around a property with a buyer and you're not sure if this house will go FHA, if we're going to have some appraisal issues. We can talk about that in depth. Just let me know whatever you guys need. I hope you enjoyed your latte and have a great day.